Welcome to Regulatory Ramblings. Our topic today is a new book entitled FinTech, Finance, Technology, and Regulation. The authors are Ross P. Buckley, a professor of law at the University of New South Wales, Douglas Arner, professor of law at HKU, and Dirk Zetzsche, a professor of financial law at the University of Luxembourg, where he holds the ADA chair in financial law. And with us today is one of the co-authors, Professor Zetzsche. Thank you for joining us.
Thank you very much for having me.
Now, your book has been described as a comprehensive, accessible work, and certainly, I didn't find it to be that esoteric. I did find it to be a good primer on the topic, and then the topics you cover are things like fintech, artificial intelligence, blockchain, big data, cloud computing, cryptocurrencies, and central bank digital currencies, along with digital ledger technology and the like, and how they interconnect. But this is a topic fintech has been well tread on by many others, as well as some of the regulatory implications, though perhaps not as much in the realm of regulation. But even still, it's a well-trodden path. What compelled you and your co-authors to write this book when the idea germinated in your heads? What drove you to complete this project?
Thank you very much, Guy. So the main objective of writing such a book is to make knowledge accessible that is not accessible in the same way before. Our particular perspective is an interdisciplinary one. We cover, as the title suggests, technology, finance, and regulation in a comprehensive way. In most contributions so far, you find either only one technology primarily discussed, often artificial intelligence or distributed ledger technologies. And most authors lack the comprehensive view that links the finance and tech perspective to regulation. So this is not a book only about regulation, but we try to show the link between the three different fields and send the overall message that if these are rightfully understood, well managed, and regulated in a proportionate manner, that the fintech movement of today can help us to further sustainable development.
The point about accessibility is key, in that academia often writes for others within academia. Academics get known within their field, globally. People get known within their niche, but in that sense, their knowledge isn't accessible. Academics often write for their own kind, and outside of academia, maybe they want to shape policy. This book's written in an accessible way, so you have a broader audience in mind, clearly. But if we had to pinpoint it, who's the intended audience outside of academia for this book?
So our authorship in the last years, because we were contributing to the fintech literature quite significantly since 2015 already, our authorship usually is aiming at a mix of audiences. While on the one hand, we have reached through journal articles and also peer-reviewed publications before the highest academic merits, on the other hand, we had already a wide following among the regulators, the fintech entrepreneurs, and the public at large. And that inspired us to write a book that would cover this broad audience, and at the same time is available as a source for citations for everyone who wants to go into fintech the first time. So it's a bit of a compromise here, that we have tried to write in an accessible manner, but explain technical concepts in a way that after reading the book, that when you come from either the tech or the finance space or also the regulatory space, that you get the knowledge necessary from the other fields to understand the concerns of the other areas of knowledge, so to say. Let me give you an example. Very often we had financial entrepreneurs working on one technology, and they were missing out concerns in the field of financial stability or also in payments regulation. And so this kind of silo thinking was a main impediment to a successful understanding of what they were doing. When you look at a technology in an isolated manner, you don't see the implications for the financial system or for society at large. And so this kind of silo thinking, which is very much present in the fintech space, has probably reduced acceptance by the other constituencies, which will be impacted by financial innovation. And to remedy that type of deficiency, our book would be quite instrumental.
Books of this nature, to the extent that I've read them in the past, either tend to be very broad, very conceptual. Then people are like, well, it isn't that practical. The ones that do get into granular detail, unfortunately, are really more intended for those with those technology and finance backgrounds, and they are laden with jargon. I didn't notice that much jargon in your book.
I think this is a compliment.
Yeah, but I think most people would say yes.
Yeah, what we do is we start with general concepts and we become more and more granular to the end. And in between, we also accept that some readers will seek solutions on individual challenges they're facing. So an entrepreneur active in blockchain and distributed ledger technology will look for different type of information than someone who deals with big data and artificial intelligence. So in this regard, we have the general concepts at the beginning of the book. We deal with each technology separately in order to provide this kind of finance technology law perspective. And then we put it all together in a context from the perspective of the respective objective of a given application, trying to see to what extent, for instance, the large-scale adoption of a given technology leads to platformization of finance, and that will lead to monopolization and monopolization effects, and these monopolization effects in the end can be harmful to innovation. So something that is very contributing to innovation in the first place may lead to a state which is disadvantage for society at the very end. So it's important that we find a way by regulatory means, for instance, to reap the profits, the benefits of the innovation in the early stage, and avoid that we get to a stage where platformization, monopolization of certain services then slows down the societal effects of a given innovation. And so we try to look both in the particularities of technology in the mid part of the book and in the broader concept at the beginning and in the end. So we try to avoid our jargon, and we introduce a terminology throughout the book that we've used. So we try to retain a level of accessibility that is crucial for also a reader who is not spending 27 hours a day on fintech.
Yeah, because I mean, one thing with jargon is, okay, the obvious problem of people don't know a lot of what the nomenclature means. But the flip side of the coin is people sometimes think that because they know the definitions of certain jargon, certain buzzwords, there is a term that they're buzzword compliant, but that's not the same as actual knowledge of the subject matter. That they're, you know what I'm saying? It requires, as an educator, the striking the right balance, because it's not just you don't just want to leave people with certain, the definitions of certain terms, that's not real knowledge of the subject matter. It may be enough to get you past an examination, but I don't necessarily think that's what you want to leave them with. More of a organic understanding of the whole, say 20 key concepts in this field that's important for you to retain when you put down this book. I'd like to come to something that I guess it's a key thread throughout the book, which is the technological transformation of finance and the role of tech and the role of regulation. Could you flesh that out for me a bit more? Because I think many people understand the finance part. They understand how technology has transformed finance just in terms of how many people are doing online banking in the last 10 years, the last generation. But in terms of technology transforming law, in terms of technology transforming regulation, outside of the initiated, that's probably not something too many people know about. The term Regtech, people hear it, they're not quite sure what it means. How has technology influenced regulation, particularly financial regulation?
Maybe we start out with an insight that FinTech has become from high street to main street. Meanwhile, everyone is doing FinTech. You mentioned online banking, but when you're looking at your cell phone, how many payment functions, finance functions, advisory tools you have there, FinTech is not a particularity anymore. FinTech is embedded in our daily life, from online banking to investment advice to for instance, insurance, or also simple things. You just need to imagine what happens if you lose your cell phone, what happens to your financial independence these days. And then, the dependency of for many of us on FinTech. But of course, FinTech is much more than just an online access to financial services. It is in many ways the intelligence in the back office of the financial institution that has been changed. And of course, when we speak about artificial intelligence, it's very important to understand what we mean. Many people think they speak about artificial intelligence when they mean, in fact, just algorithms, if-then connections programmed by humans. Where artificial intelligence is really getting interesting is where we have machines teaching themselves about better decision making. And of course, that's getting increasingly complex about risk management, risk controls. What do we do if one of these algorithms is maybe resulting in a decision that is beneficial for some player, but not for society at large? So you can imagine that there are thousands of new questions coming up. And of course, one part of regulation is to deal with these new questions. Another question that comes from it is distributed ledger is usually storage of financial data across a multiple number of nodes. And while in traditional finance, we have usually one centralized balance sheet where all of these transactions are accumulated and booked on. And when you now give up this balance sheet, the question comes, where do we see the liabilities? Where do we see the obligations that have been taken on throughout the financial transactions? And then the answer is, it is either nowhere or it is everywhere. And if it's nowhere, then we ask, how can you have a reliable counterparty? And if it's everywhere, then maybe a lot of people are spread in the net of liability because they were acting together by way of a distributed ledger. So what you can imagine here is that the new technology challenged finance, how it was traditionally thought through, simply because the concepts are not fitting in how finance was understanding itself for the last 500 years. The other thing is that also FinTech has changed the needs of the side of regulators to supervise the financial activities. If the machine, rather than the human, is taking decisions, then the supervisors must use and employ means focusing on technologies. That means, for instance, one algorithm checking another one. If you just think about the speed, we have in some financial services markets, derivatives trading, we have trillions of transactions in a single day. It's impossible that humans control these transactions for counterparty risk, for insider trading, for also the involvement of parties that shouldn't be, which we call money laundering controls and anti-terrorist financing measures. If you want to check these trillions of transactions a day for all of these public policy objectives, you need technology to do so. It's impossible to do this with human labor anymore. And that is the other buzzword we used, Regtech, which we also discuss in a book, that a change in the way how financial services are delivered necessarily triggers a change on the regulatory side, how supervisors can keep the risk at bay that are created, and also how to make sure that the public policy perspective is still present when supervising financial services.
My next question goes to the issue of conceptualization. People hear terms like FinTech, then over time they heard InsurTech, Regtech, WealthTech. But if we were just to focus on the main two that seem to be of interest to people, FinTech and Regtech, how do we conceptualize the two? Because there is overlap between them. Should we think of Regtech as an outgrowth, a subset of FinTech, or is it fair to say that Regtech is now firmly, decidedly a field of its own? How should we conceptualize the two?
Regtech is a field of its own, clear answer, but FinTech makes it necessary that Regtech becomes more advanced and develops as fast as FinTech does. So Regtech can also be thought of as something very simple. When you think about traffic policing, we have in several countries of the world automatic sanctioning. That means you're speeding, you get the ticket, everything is fully automatized. And this is the only way how societies can deal with large-scale non-compliance. Think of a fairly large nation like China. When you have a lot of people violating traffic controls, then there is no other way than automatization to ensure that people keep their respective speed limits. Otherwise, there would be mass-scale non-compliance. And of course, you can take this field of speeding and see that in the beginning, Regtech has very little to do with FinTech. But there are three elements of that analogy which also work in financial services. On the one hand, the speed matter. Financial services have become increasingly speedy. 100, 120, 150 years ago, information trickled into the financial markets over several days. As a result, it was days until a certain information was the basis of trading and the price had adjusted to that new information. Let's take as an example, we had the exploration of a new, very large oil well, which was able to influence oil prices. It took several days until the price of oil adjusted to that information. Today, it takes seconds because of the speed of information, the mass of data gathering machines, and the type of algorithms used on the side of oil traders to identify the availability of oil, the likelihood that it is basically generated, exported, and transported. And all of this information is within seconds traded upon. So number one element is speed. Number two element of this kind of sanctioning thing is the interest of the public, that its own policy objectives have still a meaning. If FinTech means that people can finance terrorism or that illicit actors can maintain their profits, then FinTech would be a threat to society. And here, when you think of the early days of Bitcoin, Bitcoin started to a large extent as something outside of AML CTF controls. Then, of course, society has an interest to get hold of these technologies. And since much of these transactions take place outside of the established actors under regulation, the regulatory side must develop new tools that capture the new transaction types. For instance, what we see in the last years is that regulators increasingly tap into the data flow related to crypto assets to identify where this data flow is heading. We had also private enforcement actions trying to identify, for instance, after assets were misappropriated, where these type of assets are heading. And that's, of course, not booked and not visible in a bank account. It is a kind of technical way of identifying where things are going to. And this is also an element of Regtech. And the third element, also, again, when it comes to sanctioning, important is that we need effective enforcement. Effective enforcement is more than knowing what is going on. Effective enforcement means also collaboration of regulators. In the past, you could stay within your jurisdiction and try to undertake illicit actions. But the reality has become that financial services due to FinTech are more international, more widely spread. Distributed ledger technology is taking place worldwide. Bitcoin is held everywhere on the planet. And that means regulators need to interact, need to swap information, need to identify sources on which they can rely on when they want to enforce certain laws and also apply sanctions. And here it is quite important to understand that speed, internationalization, and distribution of functions is a huge enforcement challenge. And this is where Regtech can respond to, as it leads to the reintegration of these three elements in one coherent enforcement approach.
Some years ago, when I interviewed Professor Arner on this topic, my understanding was at the time, the way he explained it to me was that they are connected, and that Regtech should be seen as an outgrowth of FinTech. But I want to get specific. From the example you gave, if we're talking about asset tracing to see where funds ultimately ended up, that's more in the province of Regtech. That's not the kind of information a regular bank customer would be able to see, given their terminal, given their access as a client. That's something the bank could do. That's something law enforcement could do. But let's take something like onboarding of a client and KYC. Is that more in the realm of FinTech, or is that more in the realm of Regtech, or both? Because clearly there is some degree of overlap, that they progress in tandem. Innovations in one influence the other. So is onboarding of a client and know your customer, is that more FinTech or Regtech?
I like your expression of a tandem. Financial services necessitate money laundering controls. So in this regard, the regulatory requirement is that financial actors make sure that money laundering controls have been implemented. But the way how these things are exercised is strongly dependent on regulatory technologies. So let me give you an example from Luxembourg, one of the largest European financial centers. Here we have elements where on several sides of the transactions are the same people. Now, in a place where you have 50% of the world's capital flows being concentrated, then this means that at some point in the transaction, you're always dealing with more or less the same people. And that means there's a strong case for concentrating money laundering controls, a strong case for building up databases that can verify multiple transactions from similar actors at the same time. So there is only a limited number of, for instance, institutional investors, let's say 5,000 to 10,000 globally. And if you have them properly identified, for instance, by way of legal entity identifiers or transaction identifiers, then you can clarify by connecting these transaction files with respective AML CTF databases quite fast and make sure that the regulatory requirements on money laundering controls do not hamper the transaction, because, as we mentioned a bit earlier, transaction speeds matters. It matters a lot to take advantage of information that you have generated yourself. So in this regard, the regulatory requirements come from FinTech, but how they are implemented, how they are executed is to a large part what we would refer to as Regtech. But I see little purpose in trying really to put a sharp line in between, because your initial expression as a tandem, I think, covers it very well.
As students, we're taught things in an insular, discrete, compartmentalized way, because that aids the process of learning. Certainly, I think in practice, the barriers are more permeable than people would like to think between these fields.
Of course, the introduction of technological innovation at large challenges also the way how we teach things. And for instance, we at the University of Luxembourg have introduced a FinTech master program, and now that there is a FinTech, a massive open online course at Hong Kong University. So this is something that definitely has changed academia, in the sense that we don't teach silo-like subject matters anymore, but also in our basic courses. For instance, we have a collective investment schemes master at the University of Luxembourg. There we have also modules on FinTech and Regtech in the meanwhile. Yeah? So introducing these subject matters very early on to young scholars, young students, young future practitioners, so that they can think of it at a time when they can still gather knowledge in other disciplines, is extremely crucial for understanding what we're doing about. I think silo thinking was not only present in practice, it was also present to a large scale in academia. And here I'm sure that the interdisciplinary approach we present throughout the book is where the future lies. So on the side of regulators, on the side of practitioners, on the side of politicians, and of course also in academia, both in teaching and in research.
Your book also addresses, and I quote, you address the central role of infrastructure in digital financial transformation, highlighting lessons from China, India, and the EU, as well as the impact of pandemics and other sustainability crises, while considering the risks generated by FinTech. Let's talk about the infrastructure part of that. Why is infrastructure so key here, or is it just a matter of, if you don't have the right infrastructure, you'll be left behind, hence the disparity in jurisdictions, hence the different levels of economic development? What is crucial about infrastructure when it comes to digital transformation and the rollout of FinTech?
Yeah, as we mentioned earlier on, most people think about FinTech as front-end matter. Yeah? So the cell phone, and that's FinTech. But the truth is, when you think of a mass-scale financial application, all what matters is that someone receives the orders you give, someone must be able to process, someone must be able to execute transactions in the back. And at the heart of every FinTech system lies infrastructure that connects all these front-end applications and that puts, so to say, intelligence into the system. If we think of transactions just as supply and demand, it would only work if you have one party on the one side and another party on the other side connected to each other. But of course, the idea of financial services is that we have something like a pooling taking place somewhere in the system. And how these pooling can take place, what you allocate to which part of the pool, what type of mass liquidity we generate by this way, strongly depends on the strength of your infrastructure, the resilience of your infrastructure, and the way that it connects as many players in the financial system as potentially possible. And that has become quite apparent during the pandemic, because before the pandemic, in particular, many non-enthusiasts were less open to using mobile devices, for instance, for their financial transactions. There was a risk implicit, elderly folks had no access. So it was primarily on paper all through the world. There were a couple of countries that were moving a bit ahead. So China, Hong Kong was quite advanced, but also South Korea. We had a number of Japan, but we had a number of countries that were advancing there. But it was not something like a worldwide trend. It was something on the far horizon. And the pandemic had triggered now an acceleration of financial services in a digital way. We see this, for instance, on countries like the Philippines, that prior to the pandemic had 20-25% of banking, and after the crisis had more than 65% banking. And if you look at these figures, we have to see that these 40% are primarily contributed to digital access to finance. And this type of progress, which was possible for quite some time, has been triggered by the pandemic, but at the same time, the limitations became apparent, because during the pandemic, where the infrastructure was not resilient, the access that could be provided theoretically on the front end could not result in efficient allocation of capital due to deficiencies on the back end. So when you think of it, that these multiple agents, these front end agents, the cell phone or some other type of digital device, as the kind of entry gates, then there must be a connecting element in the whole financial system. And this is what the technical infrastructure is. That means if you want to build a well-functioning financial system in a digital way today, you need to focus on this infrastructure. You need to think about how to grant regulators access to this infrastructure. And you need to think about how to build capacity to manage the infrastructure, to maintain it well, and to make sure that there are as little cyber attacks or other cybersecurity risks as potentially possible.
I appreciate that you brought up the back office function that connects everything, because as you said, when people think about fintech, they think of the front end, they think of the point of contact, they think of using their smartphones to conduct their transactions, make purchases, scan, swipe, be done with it. A scholar at another university put it to me like this, that that back office function, he said, is akin to the Hollywood stuntman that you don't see or hear about, but they make the main star look good at street level. Hence the lines of a song where I'm the unknown stuntman who make Redford look so fine. So I thought that was an interesting metaphor. And I'm also glad you brought up the pandemic, because, I mean, the narrative is, and I'd like to hear if you agree with it, the pandemic accelerated the adoption of fintech globally. Some were already at an advanced stage, and you named some jurisdictions. Others had to catch up. In some cases, they had to catch up during the pandemic. Is that a fair statement, that the pandemic accelerated the adoption of fintech?
Well, there was a strong need for government-to-people payments throughout the pandemic. And at places where people were not connected to the banking system prior to the pandemic, there was no way to channel funds to people that could not go to work anymore. Because of social distancing, there was no way to hand over cash in a physical manner. So it was quite simple, digitalize or die. And that in most countries of the world in a very literal sense, because we should not forget that we had, prior to the pandemic, just 50 million people in starvation. But throughout the pandemic, this number rose to more than 800 million today. And there you see the dependency on commercial transactions. And if commercial transactions depend on digital transactions, because this was the only way how we could exchange money, it was extremely important to digitalize, to get access to the financial system by way of fintech means, although we're not always talking here about very advanced mechanisms. It could be a kind of cell phone-based SMS style way of wiring money. The way how we do this is not so important. It's much more important that we do it, that we have this type of access to allow for government to people payments. And once these government to people payments were developed, the next stage was that the same type of technology could also be used for more advanced ways. For instance, for granting small saving schemes to ensure that school fees for the kids could be paid in 6 months from now, to maybe also enter into kind of micro-insurance contract, or also to some more advanced long-term saving schemes that are diversified and so on. So once you have the access is key. Access is necessary for survival in many parts of the world. And in this regard, once access was established, it could be utilized for many other very useful applications on the planet. So to get back to your original question, the initial access necessary and crucial for government to people support then resulted in what we can think of today as a fintech boom. But no one thought about large-scale fintech policies. Everyone cared about how do we ensure that people can eat tomorrow.
Is that typical then, that the commercial activity and the technological development takes place first, and then the rules and regs follow? That has traditionally been the historical pattern.
Well, I was involved in a number of advisory panels to deal with the problem of how to ensure AML KYC requirements when we now onboard thousands and millions of people basically overnight to ensure that they can survive. People who, to a large extent, were not documented. You couldn't go into a bank office just to show your passport. So how do you reconcile, on the one hand, the need to have a more or less clean financial system with the need to grant access? And there were a lot of new concepts developed that resulted in a bit of a compromise. So, for instance, you had, let's say, one layer of accounts for smaller transactions, which have been less scrutinized in terms of AML KYC. And as soon as the transactions were growing, the requirements were intensified and better documentation was required. So a lot of these proportionality requirements, or a lot of the perspectives of regulators have been adjusted to the needs of the pandemic, or created through the pandemic, but the needs were, of course, those of the people. And I think this is what regulators always do. I've seen very rarely regulators who are bad meaning. They're always well meaning. They want to be innovative. They want to kind of allow for useful technologies. There is, of course, a huge degree of information asymmetry between the financial entrepreneurs who think of themselves as being extremely beneficial, and the perspective of the supervisors who may realize that the benefits are primarily granted to the entrepreneur themselves rather than to society. And because if you create a risk for others while creating profits for yourself, these externalities may be a good reason for why you should not pursue this activity in the absence of regulation, supervision, and maybe also enforcement activities. So this type of tension is always present in regulators. But throughout the pandemic, we had the special situation that many of these tensions were pushed aside simply because the need of people, the dependency of people on the financial system was becoming so an overarching priority that all of a sudden simply granting access became the number one policy goal, irrespective of risks. And now, of course, once the people are in the financial system by way of electronic means, we can find now electronic means to, for instance, monitor the activities. Here again, think of fintech as a front and back end system. Maybe there is an alternative way to screening clients on the front end, which is back end, when you can just observe where they're channeling their money to. That may be also a way to monitor them in terms of AML CTF, because most of these transactions are entirely unsuspicious, but some of them are not unsuspicious. And so maybe we can identify these transactions better once they're taking place within the financial system, and then respond to well-justified AML CTF concerns here. Yeah, so you see that one policy need became, through the crisis, extremely important. And that has triggered another cycle of Regtech and adjustment of the rules and responsiveness of the regulators. And I'm thinking this, in this regard, the pandemic is an event study like one we've rarely seen before in history, that the policy objective of access has become so important as compared to any other policy objective the regulators are pursuing.
It certainly seems as though the potential is there for FinTech to be a vehicle to ensure the general basic welfare of a society in terms of, as you said, getting funds to people in need. But clearly, and you point this out in your book with your co-authors, that there are also risks generated by FinTech. Could you highlight some of those key risks?
Yeah, well, the first type of risk that's always at the forefront of regulators is the instability of the technology applied. Artificial intelligence sounds wonderful, but when you understand what is happening on the tech side, then you think twice as a regulator whether you want this in the system. In some artificial intelligence applications, a certain computer sifts for a certain, or searches through a given database for a certain type of information and then takes independent trading decisions. And we don't have to go that far back, but we find already in the 1990s malfunctions of these algorithms which were able to destabilize the global financial markets. So financial stability is often a main concern. Another main concern is, of course, client or investor protection. Not everyone who can program a computer is a stable individual, is an honest individual, and is capable of understanding the risks they're creating. And of course, there is also no rule in the world that someone who can code a software code is not stealing money. So finance a history of fear and fraud, I used to say in my lectures. And what I mean by this is that when you have clients' money at your disposal, more often than not, there is a case where someone is stealing it, and that someone can come from the outside, but of course it can also come from the inside. So regulators are increasingly interested in maintaining trust of the system by ensuring client protection. Because once you have lost your money, you will lose the faith in the financial system. You will not allocate the blame to that one entrepreneur because it was hidden behind a computer system. So rather than that, you will try to opt out of the financial system and turn your proceeds to somewhere else, and that is harmful for society. But of course, client protection, investor protection is the second main concern. Then we were already discussing about the need of maintaining a market integrity in the sense that we have that we provide as little as possible options to allow criminals to benefit from their financial income generated by illicit means. Then we have, of course, the concern that we want to make sure that the respective financial system is open to innovation so that it increases in efficiency, that it allows for new business models to come up, so openness to innovation. And what we lay out in our book, and which is a bit of a overall conclusion, is that if we do all of this right, we also further sustainable development. Sustainable development understood as furthering of the United Nations Sustainable Development Goals. And I think this is an insight that few have expressed prior to our research laid out in this book, that the overall purpose is not a kind of isolated pursuit of one of the regulatory perspectives, but the overall purpose of finding the right balance between innovation, regulation, financial efficiency, and so on, is to further the long-term good of the societies. And I think we make this argument quite strongly at the end of the book.
A lot's been said about AI, different uses. I mean, chatbots, what have you. And to your point about not everyone who writes code is necessarily what well balanced or has the best of intentions at heart. I mean, one could easily point to the case of long-term capital management in the 90s, and simply having a algorithm and a firm and having an algorithm that was developed by two Nobel Prize winners is no guarantee of success.
Well, there are two things. There is dishonesty and incompetence, but maybe also the simple problem that humans program code, that their rationality is limited.
They think they're smarter than they are, and sometimes it doesn't. There are related fields that you can be successful. I mean, we know many talented mathematicians, rocket scientists, astronomers, because of their proficiency in math, are hired by hedge funds, and they can do that part right. But when you try to get them to branch out of their lane, they're not as good. I mean, what one can think of Sakharov in the 60s and 70s, thinking, I'm one of the best and brightest scientific minds of my day. Surely I can do politics. It didn't work out that well for him because it's a different field. I guess what I'm saying is sometimes people think that they're more competent than they really are, and that applies to creating algorithms as well.
Well, to say this a bit with an ironical twinkle of my eye, it has happened to professors before that they think they're smarter than they are. So, yes, of course. So we all have to treat with these topics a bit with humility and understanding the limitation of mankind, which is they understand only a part of what they're doing, and because the world is an endlessly complex system, and every individual has limited capacity to think of the repercussions of any given activity. And that is, of course, self-protection. You can process, maybe even if you're a very intelligent person, you can process maybe a couple of 100 factors. But the world is an endlessly complex multi-factor model, and it is impossible to consider whatever happens on the very, very remote part of your conscience. So you mentioned LTCM, and this was in fact the case I had in mind when I spoke about the externality risk with regard to financial stability, because it is one of the cases where very greedy, very well-programmed, greedy algorithm resulted in externalities. But of course, you don't have to go that far. You can also look at many more recent applications in the fintech space that show similar features, that you reap the profits for your own centralized balance sheet and leave the losses to someone else. To some extent, this is what market capitalism is about. But of course, when the problem comes that this type of structure may also lead in your own entity being unstable and you providing as function a counterparty a kind of risk of default to others, then we understand why there was financial regulation in the first place, which is enhancement of financial stability. We want to have a crucial part of the financial system, only entities that are sufficiently robust and resilient to maintain their services even in times of crisis and pressure. And this is exactly something that most fintech entrepreneurs don't understand. Many fintech ecosystems aim at a small financial system in their self. And that usually works well when you have a very small number of clients. But as soon as you include clients that are vulnerable, that are basically just widows and orphans, people who depend on you, then it is crucial for the well-being of society at large that these kind of small financial systems, called fintech ecosystems or however we want to call them, that these are stable, that they are also considerate of the needs and of the vulnerability of their clients. And this is what financial regulation ensures in all advanced societies. We want to keep not only the infidel and the dishonest out of the system, we also want to make sure that there's a balance between risk and opportunities, and that you don't try to misappropriate assets from vulnerable parts of society. And for that reason, we have licensing in place, we have conduct rules in place, We have the need to inform and warn the clients. In some cases, even certain transactions are prohibited for certain clientele. And all of these rationalities apply to the same extent, if not even more, also to FinTech services. FinTech, in this regard, when you think of client protection rationally, FinTech enhances complexity, and that means you find more vulnerable clients on the other side of the transaction. And this is exactly what is also the common theme throughout the book. FinTech is a huge opportunity, but it requires a proportionate, balanced regulation, considerate of the risks. So openness to innovation, yes, but with exemplary at the gates.
If you were to explain it to someone who's a layperson, if you were to explain to them, what will AI mean for FinTech and or Regtech? What would you say to them? What are the implications?
Humankind tends to overestimate the short-term aspects and underestimate the long-term impacts of a given innovation. So in light of this, I would say short-term, nothing will change so overnight. There will be a number of applications, which we know in trading, of asset trading and so on, where artificial intelligence is already identifying investment opportunities and enhances speed, because it's just so much faster than what humans can do. But it has not yet been this game changer. Or we could say, defining artificial intelligence more broadly, to a certain extent, it is already present and will not change anything overnight. But where I see an immense change long-term is that this type of back-end intelligence moves forward to the front end. So right now, much of artificial intelligence is beneficial on the back end, at the side of intermediaries. And what I could imagine is that this type of back-end use moves more to the front end, where it assists then the client. We have certain trends already in finance which kind of facilitate that. And if we think of the future, we could imagine that the client side gets better advice, better portfolio selection, and maybe also opts out of full asset classes due to more advanced agents, fully artificially intelligent agents coming to the client's support. This is what I predict. Right now, the focus is on the back end, simply because it requires large investments. It requires a lot of risk management right now to deal with AI. But I think to the same extent as other technologies, let's call the cell phone, take even old ancient stuff like the fax machine, has become widely spread throughout society. I think the same will happen also with regard to artificial intelligence.
That's pretty far-reaching. Now, your book concludes with, I quote, "By offering forward-looking regulatory strategies to address the challenges facing our world today," end quote. Could you you alluded to some of that already? Could you elaborate? What are from a regulatory policy perspective, what are some of the prescriptions you're arguing in favor of?
The first is we need to avoid regulatory approaches that focus on one technology. We should rather think about risk concepts, and where certain risk is present, that shall justify regulatory intervention. We mentioned the risk of financial instability. We mentioned the risk of misappropriation of client assets, or also wrong investment decisions at large. So where these risks are present, regulators shall have the means to intervene, irrespective of which technology creates these type of risks. The second thing is proportionality. When you have very large amounts at risk, there is an imminent need to act swiftly and decisively. When very small means are at risk, and maybe you can even isolate these risks within a group of risk-aware investors, professional investors, or large pockets of money, which are not sensitive to losses, then your regulatory intervention can be let's say, less pronounced, maybe you can just limit yourself to certain disclosure requirements so that you know what's going on without really setting any barrier. This way, you can spur and further innovation while keeping risks where they can be borne. Because one thing is sure, every innovation creates risks, and some of these risks will materialize. And it's a task of regulation to distinguish between those parts of society where the risk can be borne and internalized without creating havoc, and those parts of societies that are vulnerable, including, by the way, the financial system, which is a vulnerable institution, and thereby allow for a type of stability or further stability of the financial system. The third lesson that we have learned throughout the research over the last 7 years is that academic thinking must trickle into the mindset of regulators. It is not paper-based documentary effort anymore to be a supervisor. It is much more academic in the sense that you need to understand what you're doing, that it's a bit of a research approach to understand the type of risk created, the type of interlinkages, and so on. And only after you've done that type of inquiry, you can take a good and tailored regulatory action. So in this regard, the mindset must change from a typical bureaucrat and more move into the curiosity with regard to a given innovation that is usually characteristic more of an academic. And of course, the fourth element is that nothing works with resources. You cannot expect good regulation when you don't invest in regulators. That means the regulators must be staffed adequately. They must be, they must having the resources. And where in countries where you cannot give the resource directly to the regulator, maybe then a cooperative approach of different parts of society, of regulators, of finance experts, a kind of collaborative effort may also result in the necessary degree of knowledge, which is the precondition for a sound, proportionate, but nevertheless risk-aware regulation.
Beyond resources, it oftentimes seems as though this is a recurring topic on regulatory ramblings. Oftentimes regulators are not techies. That they oftentimes have backgrounds in financial services or law or both, but they don't have the requisite level of tech savvy. And beyond that, on the topic of regulation, should we be swayed by the techno evangelists, the FinTech and cryptocurrency libertarians in Silicon Valley who say regulation will stifle or if not kill a budding industry?
Well, to the same extent that certain regulators are not techies, the techies have very little understanding of finance and law. Well, so the blindness is on all sides. It's only a matter of degree and on the focus. Yeah, some spots are always not covered when you're an individual coming from one discipline. I think the basic insight is that all of the three different disciplines are necessary and that they need to understand each other to the best extent possible to find the common ground on which societies can make progress. Because a pure libertarian view will probably lead nowhere. And this is a clear message that we send throughout the book. Innovation is positive, but not only positive. Every innovation always includes also risk. I'm not aware of a single innovation that is purely good. So it is about regulation to make sure that the innovation can be used in a beneficial manner to society, not only to the entrepreneur. And it is about finance to provide the financing for these type of beneficial innovations and make sure that they can succeed and widely spread throughout society. Let's say that way. There are several ways to answer the question, when is the right time to regulate? Because that you have you regulate, I just pointed out. Yeah? So the question is not if, but when to regulate. And here, I think it's crucial that we allow for a room for experiment. We can do this, for instance, with size-based thresholds, or we can do it under a certain kind of protected environment for innovation. We call that regulatory sandbox. We can also do it on a kind of advisory-based scheme. Yeah, so innovation hub by regulators is often something like advice early on, so that you avoid certain type of risks which are apparent in your business model. But the question of when to regulate has three different answers depending on the risk sensitivity of your society. When you think your society accepts that certain risks are put on widows and orphans, then you can afford maybe to regulate quite late in the game and accept fast innovation. When the other alternative is to implement regulation early on, but make sure that the losses are curtailed in the sense that only part of society which can bear these risks, rich investors, family offices, sophisticated investors, that they are exposed to the risks. But this is already a type of regulation, you know. So if you have that type of regulation that you can limit the risk to those who are risk ready, then of course you can regulate, relatively speaking, late. But it's important to know that this is not purely libertarian, what I'm just expressing. It already requires a regulator that sanctions severely any effort to sell risky products to vulnerable parts of society. And of course, a very heavy-handed approach would require for permission for any type of service. Of course, the libertarians will say that already this type of middle ground regulation, which I expressed, is heavy-handed because it restricts access to large-scale applications, because there are not millions and millions of risk-ready or investors or risk-ready clients. And that means any platformization, any use of economies of scale will require you to reach out to the public at large at some point in time. And there we say, yes, you can do it, but under a certain proportionate regulation, because otherwise society will not allow you to pursue that business model long term. And that wouldn't be in the interest of sustainable development.
Well put. I think we've covered a lot of ground. In the time we've got left, are there any key takeaways, central points, main conclusions or observations from your book that you'd like to leave our listeners and hopefully potential readers with? I hope they will get the book. Anything you feel we haven't covered?
Well, let me just point out the three words in the subtitle. Neither technology, nor finance, nor regulation exists because of their own purpose. They all should be utilized to further the long-term stability, the long-term development of societies. And to make that sure, it's crucial that the three disciplines interact. We hope to provide evidence to that thesis throughout the book by arguing that innovation can be wonderful under the right conditions. And finance and law set these conditions. Very often finance more in a facilitating way. If there's a huge profit opportunity in it, then of course it will be fairly easy to find capital. And at the same time, law more from a restrictive, preventive point of view, but also from a sanctioning point of view. If these three disciplines interact, the ideal middle ground they will aim at will be sustainable development. And every effort in regulation, finance, and technology should be measured against that benchmark.
Well, Professor Dirk Zetzsche, thank you so much for your time and an engaging conversation, and I hope the book sells well.
Thank you very much for your time.
The book is FinTech, Finance, Technology, and Regulation. Get it. I think you'll find it to be a good read. It's very topical and timely. And to our viewers and listeners, thank you again for joining us. Until next time.